Welcome to the Jay Martin Show, where we dissect the greatest minds in geopolitics and finance. My guest today is the founder of Lyn Alden Investment Strategy and the author of this book right here called Broken Money. And today we dispel all of the narratives surrounding America's deficit and debts and get down to what really matters. Rich episode. You're going to love it. Here is Lyn Alden. Enjoy.
This is Jay Martin.
All right, here I am with Lyn Alden. Lyn, it's great to see you again. Thanks so much for making the time to come back on the show.
Great to be back on the show. Thanks for having me.
Okay, there's like a million and one things that we can talk about since the last time we chatted. So here's where I want to start, just to kind of crack you open where your head's at. What are you most focused on, macro, geopolitical? Like, what's getting the majority of your attention right now?
Macro-wise, it's mostly the sustained fiscal deficits, of which the most recent catalyst is the big beautiful bill. Kind of watching the details unfold there over the course of these past weeks. That's probably the biggest thing. The second biggest thing would be tariff policy and overall geopolitics, because they're kind of interrelated. Obviously, the brief flare-up we saw in the Middle East, which is perhaps not entirely over, but we seem to be past the heated part. That was worth watching for several days, but fortunately it ended rather rapidly. So for me, it's mostly the fiscal side and the tariff side.
Yeah. Okay. So maybe break that down, the sustained deficit issue for me a little bit. And then I know there's going to be a handful of threads I'm going to want to pull on.
So throughout the whole pandemic period and then post-pandemic, I've generally viewed that the size of the fiscal deficit is more impactful than, say, most market participants seem to have expected. So whether it's expecting inflation to come ahead of time or expecting kind of economic reacceleration in 2023 and 2024, the size and sustained of fiscal deficits are pretty unprecedented. Generally speaking, you have really big deficits during certain recessions. But on a sustained basis, this is very unusual. And it's largely disconnected from the economic cycle now. It's tied to demographics. It's tied to debt accumulation and interest expense. So there are multiple things that keep it rather sustained. And that is kind of a run it hot playbook. And so even when you have parts of the economy that are strained, other parts still tend to run hotter than you'd otherwise expect. I've kind of used the analogy that it's sort of like an emerging market recession in a way, or an emerging market light. Which is to say that instead of this big unemployment cycle, this big kind of disinflationary monetary cycle that recessions are normally viewed as, it's more of like a debasement cycle, and it's more of this kind of a stagnation where things nominally are generally still up and to the right, even as the quality of things maybe goes sideways to down for a period of time. And so it just kind of changes the characteristics of both markets and the economy. And then, of course, tariff policy is a big deal. We have the highest tariffs in decades. It's kind of a new period of partial deglobalization, more frictions between trading partners, potentially shifting of revenue. So it does impact the size of the deficit to a maybe smaller degree than many people realize. But part of monitoring it is determining how big it's going to impact the deficit. And so those are all the factors I'm kind of looking at. The tariffs also can impact, of course, corporate margins, which is relevant for equity investing and overall potential economic, either slowdowns or accelerations. Those are the biggest factors. And I've been less focused on what the Fed's doing and more focused on, say, these fiscal things, which includes tariffs.
Yeah. Okay. So starting with some of the deficit items, then, this one's different. This is more sustainable, more unusual because it's tied to some things. You mentioned demographics. This is the aging population drawing down on Social Security more than anybody's paying into it. And that's sort of the demographic crux of that line item. Interest expense being another, right? We're now in a probably cyclical uptrend in interest rates, and that's going to be tough to break. These are the ties that make this deficit stickier, and all the sacred cows that Congress is just not going to ever be willing to cut, probably. And I guess, not to step too far adjacent, but we're geopolitically unstable. The world is more geopolitically unstable than it's been in my lifetime. So we can't really expect military expense to do anything but go up, probably, right?
Yeah, I agree. And when people think of aging demographics, they often assume disinflation because generally speaking, older individuals, they're not
Mm.
they're downgrading their house rather than upgrading their house. They're
Yep.
driving less. They're consuming less on average. But it partially depends on what type of economy it is. So, for example, in China, which is also aging, they don't really have a really big senior support system in place. And so as they age, they're partially on their own in terms of what they worked for their whole life and how they're going to kind of wind down spending as they age. In the United States, we have Social Security and we have Medicare. With Medicare being particularly relevant because we have the highest per capita healthcare costs in the world, including much higher than older countries than us. Like Japan, on average, is 10 years older, and we spend way more per capita on healthcare than they do, with lower life expectancies to show for it. So the combination of the fact that we're just spewing out a lot of money toward that aging class makes it less disinflationary than you'd expect. Because I mean, especially the top third income wise of retirees, they're traveling. They're financing some of their kids' expenses, like their adult children, their weddings, their first home buying, their own travels, their first car. So that expenditure does find its way into the economy, either through the seniors themselves or through all the tons of people that work in healthcare and then they spend in the economy, or like you mentioned, defense. For a long time, the United States had kind of shrinking defense as a percentage of GDP. We kind of had sort of flattish
Mm.
nominal defense spending, and over time that would kind of gradually diminish from, say, the Reagan era, which is like kind of the tail end of the Cold War. We had this kind of multi-decade decline, and that seems to be bottoming out. We also see Europe upticking their defense-oriented fiscal as well. There's a recent headline that the U.S. is like short on a number of missiles,
Mm.
so they're kind of restricting shipments that they were otherwise going to send to Ukraine,
Yeah.
potentially tied to rare earths and things like that. But just overall, just our industrial base has limitations. And so, when people thought a lot of cuts were going to happen, me and CM Callahan, we did a report that we published in January. We worked on it throughout kind of the second half of 2024, and we kind of point out that there's almost nothing of scale to cut that they promised not to cut. So, for example, back in the 2010s, during the Paul Ryan era of the GOP, they were looking at trimming Social Security, trimming Medicare, raising the retirement age, that sort of thing.
Hmm.
They never were able to make it happen. There wasn't the political will to do it. The seniors actually vote, unlike the younger generations. It's very hard to cut the core things there, just very politically unpopular. And now in the 2020s, like in the 2024 GOP platform, Promise 14 was don't cut Social Security, don't cut Medicare, and don't raise retirement age, other than maybe waste around the margins. And so, if interest expense is pretty out of your hands,
Hmm.
if you're not going to cut Medicare and Social Security, if defense really only goes up and to the right, um, with all the pork and all the geopolitical issues, you can lump veterans benefits in with defense as well to some extent, or in with the other programs. That's already the vast majority of government spending. All the rest of the pie chart is all the little slices, and you can trim 20% out of all that, all the fat, all the little waste areas, and you're not going to make a dent really. And so this is pretty entrenched into the system politically, as well as the overall financialization of the economy. So it's really kind of, I mean, I keep using the phrase unstoppable train. It's a train that doesn't stop, just because it's so thoroughly entrenched.
And two of the most common responses that you probably hear when you outline this is either deficits don't matter like they used to, and a lot of the money that is owed is actually owed to Americans or American entities or American institutions, and the counterpoint to that might be a bit more bombastic, like we are staring in the face the real time collapse of the dollar, right? This train can't go much further down the track without something big breaking. And it's hard to tell what that will be, but it's probably going to happen soon. And those would be maybe opposite sides of the response coin. But how would you process either of those, Lyn, and where would you say the reality lies?
I'm actually right down the middle of those two views, because when I say nothing stops this train, there's actually two sides of it. So one is it's the bearish thing, which is basically very low probability that they're going to address the deficit anytime soon.
Right.
But the other end of it is saying that they actually still have a lot of track ahead. Because if I thought it was going to end next year, I wouldn't use that phrasing. I think it's going to extend 5,
Mm.
10 years and potentially after that. But I don't really like to forecast more than 10 because
Sure.
the world's so different. But basically, the U.S., other countries run into deficit issues generally at lower thresholds, especially if they're not in the developing world. So, for example, Brazil, over the past year, their currency weakened. There was concern around the size of their deficits. And yet, as a percentage of GDP, they were similar to the U.S. It's just that there's not a lot of external demand for Brazilian currency, and so anything that spooks investors or currency traders, they can just pull out, and so there can be a pretty sharp devaluation. In the United States, or for the United States, there's entrenched demand for the currency. So there's over somewhere in the ballpark of 18 trillion in foreign USD denominated debt. And that's mostly not owed to the U.S. That's like cross border across the world. So, for example, some entity in Brazil will owe it in China, some entity in Egypt will owe it to France.
Mm-hmm.
It's this whole kind of cross border thing, and that's denominated in dollars, and that's far larger than the monetary base of dollars. And so, even as you run really hot fiscal deficits, even as you run structural trade deficits, those, all else being equal, are generally dollar bearish. It's offset by this network effect of entrenched demand, which is not invincible, but it just basically extends the runway, extends the track for how long this can go. And we have seen, I mean, we've had dollar weakness lately, but that's from a pretty high level. We're still in what I would argue is a strong dollar cycle. The dollar's still overvalued on a trade basis. We probably should expect continued, not in a straight line, but continued dollar bearishness, because when we look forward to next year, we're probably going to see lower interest rates, especially with the new Fed chair. And that's one of the key things kind of still propping up the dollar relative to a number of other currencies. And so I think basically you can have mini crises. Like, for example, the 2022 UK gilt crisis was an issue, but no one's talking about it now because it wasn't
Right.
some cataclysm.
Yeah.
And their government being parliament is more impacted by those things than the U.S. system. And so a similar thing in the U.S. would probably be less impactful politically than it was in the U.K. And also given the size of stuff I just described. So while you can certainly have these little mini crises, these kind of unusually sharp drops in the DXY, or unusually sharp movements in treasuries and move index, and awkward periods where the central bank has to step in with some sort of liquidity provision. These things will come and go, and there'll be little mini crises, I expect. But the very large crises, unless something happens, it's unrelated to finance, some sort of political thing, political tail risk.
Right.
Aside from those, I still think there's quite a bit of track ahead. But it doesn't mean, and going back to pressing against the other side, the debt doesn't matter. There's already consequences. There's already, like, the inflation was a result of massive deficit spending that we saw, and the ongoing kind of K-shaped aspect of the economy is partially because of these fiscal deficits. So right now, the Fed's still trying to get inflation back down to their 2% target, the way they measure it. Even in their FOMC minutes, they don't expect to happen in 2027 even. Now, they could be wrong, but their current forecast is, we think it gradually goes down closer to 2%, but in 2027, they still expect it to be like 2.1%. And so they're not exactly quick to be dovish, because one of the few tools they have is high interest rates. The problem is that high interest rates does tend to slow down bank lending, but bank lending is not the source of the problem now. The large fiscal deficits are, and higher interest rates just increase the size of the deficits.
Mm-hmm.
And because money's pouring out, like I mentioned, to Social Security, Medicare, defense, interest expense, money's pouring into the economy some places, and to the foreign sector. Money's pouring out. That's stimulative. But people that are not receiving it, so generally, on average, younger middle class people, so they're not so struggling that they're getting food stamps or Medicaid, but they're also not retired. They're not on the receiving side of these deficits either. They're kind of stuck in the middle,
Mm-hmm.
and they're facing unprecedented high home costs. If they're looking to buy a new home, they're facing all these challenges, and so you have this kind of K-shaped economy, where you have very distinct winners, very distinct losers. And the deficit is part of that equation. So it already matters. It already has political consequences. It just doesn't mean it's not as though it matters all at once. It matters over time.
Yeah, that's a really interesting take because so a government deficit is in theory a private industry surplus, but that's very selective in how that's distributed. There's going to be winners and losers there in a already populist environment. That could be somewhat inflammatory,
Yeah.
and that may be the political tail risk. That that's the question mark. Impossible to predict those things, I think, but something to be aware of. And then in terms of like, it's easy to kind of pick a fight with the dollar as a commentator, but in reality, there's so much entrenched demand. You said $18 trillion in foreign US dollar debt. That's Brazil owed to Germany, et cetera, examples like that. And when there's that entrenched demand, just means a higher level of more diverse demand for that asset, which gives you more flexibility when it comes to the supply. You get a lot more leniency and allowances as a consequence. Yeah.
Yes, exactly. And whether it's the dollar dominant debt, whether it's the fact that just the U.S. Treasury market is more liquid than other sovereign bond markets, obviously they can shift toward gold, which they really have been especially since the Russia invasion of Ukraine and the subsequent freezing of some of their assets. But even before then, somewhat there's been a trend since 2009 to gradually shift a little bit more toward gold. So it's not that these things are invincible. It's just that they give a lot of track, and people often they sensationalize things. So, for example, they think that if U.S. has a pretty big misstep, it's like all over. We were talking before we recorded that. I mean, I spent part of each year in Egypt. They're currently dealing with 20 to 30% persistent money supply growth per year. So the
Right.
developing world on average grows by 7% currency, broad money. Developing markets higher. Right now, Egypt's like pushing 30%. Inflation's double digits more often than it's not. And life goes on. People are still taking their kids to childcare. People are still, work at similar jobs than they were 5 years ago. There's issues. I mean, energy per capita is down. Energy consumption per capita is down in Egypt, which is a sign of recession, even if it doesn't really show up in the GDP statistics.
Right.
And so it's not to say that things are good there. They're really not. But there's if something like that, like if there's not an outright crisis in Egypt, they of course had the IMF helping them. They had the UAE helping them because it's in nobody's interest to really have an unstable Egypt, given what's happening in the region. But basically, it takes a lot to really destabilize a developed country, let alone a reserve power. And so I just think basically people maybe they don't travel enough or they don't do enough global analysis think that the U.S. is kind of, or at least the dollar system is more fragile than it is. That as soon as we get a deficit blowout or faster than average money supply growth, that it's like a crisis is just like a year away. And like I
Yeah.
said, I mean, you can obviously have mini crises. We've had a bunch. You can define the regional banking crisis as a mini crisis. Obviously, the whole pandemic, lockdown, and stimulus was a crisis in a way. These things come and go, but for a true event, you need a lot to happen, or you need a lot of little things to happen over a much longer time period than probably most analysts think.
Yeah, and there's a couple of things to say about that. I think you mentioned this in a recent newsletter. Actually, like it's a good business if you're in media to call for the end of things, right? To have those cataclysmic predictions and forecasts, and coincidentally, you can be a doom and gloom pundit and never actually be right. Just be perpetually early, right? And it kind of holds up. And then one day you're right, and you're heralded as the oracle who saw X, Y, Z coming before anybody else did. And that can skew the narrative. And also, I wonder how much, just because there are winners and losers in today's game. And if you're on the losing end, you're going to call for the game to change, right? And that's going to add some fuel to the end of days narrative a little bit as well. If you want the reset because you feel like your hand was unfairly dealt. Do you know the $18 trillion in foreign debt? Do you know the trend or trajectory of that number, Lyn?
In recent years, that is mostly sideways. And for where I get that statistic from, that's from the BIS, the Bank for International Settlements. They, a lot of this is pretty opaque. They have probably the most sophisticated way of tracking it, given what they do and where they are. Something like 13 trillion of that is non-bank debt, so it's owed by governments and corporations. That are outside of the financial sector. That part, at least, is pretty sideways in recent years. The bank, then the rest of it is kind of bank debt. And that is only loans and securities. That does not include derivatives. So that's just loans and securities. So it's cross-border bank lending, it's cross-border bond issuance, in dollar, and that's all dollar denominated. And so, but there has been kind of a trend sideways. Historically, and there's not a ton of cycles here, but historically, that debt tends to go up during weaker dollar environments and tends to flatline during stronger dollar environments. And even with this recent self in the dollar to below 100 DXY, that's still elevated. That's still ever since around 2014, we've been in this kind of strong dollar decade. And
Yeah.
there's really only been $3 cycles since the 70s when these currencies were free floating. And we're in basically the third strong dollar period. Maybe that's ending now, but we're still in it. And so, generally speaking, when that happens, you don't have a lot of reserve accumulation among countries because they're more in currency defense mode than they are in the mode where they want to purposely weaken their currencies or accumulate reserves. And they're not kind of aggressively building credit either. And so those statistics tend to stagnate more when the dollar's strong.
Right. Okay. Okay. Thank you for that. I want to pull on the tariff thread a little bit. You're obviously watching the tariff policy and trade aggression, like all of us are. I'm curious how you interpret that. You could say that the president's making the claim that America has been treated unfairly and it's time to get even. Countries have been taking advantage of the United States, and that's got to change. The other side of the argument would say the United States has been the biggest beneficiary of globalization, actually, and this has been a net positive for America and Americans. Either one ring truer, somewhere in the middle? Where do you land on that? And what do you think's behind the sort of attempted reset on trade agreements globally from the American president?
Yeah, good set of questions. It's sort of in the middle, but not cleanly. So it's not really like a throwaway answer. So there's some areas that are very much impaired by it, and other areas that are very much helped by it. One thing I've been emphasizing, and I had an article about the trade deficit. It must have been back in 2017, 2018, because even back then it was an issue. Basically, the reserve currency status. And this goes back to Triffin dilemma, although the exact mechanism changes over time, between the Bretton Woods system and the current Eurodollar system. Having the reserve currency has a cost to it. There's a lot of privileges associated with it. We can sanction almost any country. Our currency is unnaturally strong, so that we have 800 military bases. For better or worse, we have this. It kind of extends U.S. hegemony. The downside of the system is you can look at this a couple ways. One is the whole world needs dollars, and so what they do is they overvalue the dollar compared to what they would compared to most other currencies that trade on primarily interest rate differentials and trade balances. And so the U.S. trades on those things, but it also trades on the fact that even regardless of what's happening, countries around the world need dollars. And so the dollar is kind of perpetually overvalued. Not always by the same amount, but it's kind of perpetually overvalued. And what that does is that increases our import power and decreases our export competitiveness, especially for lower margin things like manufacturing. Less so for technology, healthcare, finance, but especially for kind of physical making things, more so than even developed peers. So even compared to Europe, compared to Canada, compared to other places, even of similar wealth levels, we are kind of uniquely impaired in terms of low margin manufacturing. And so basically, because of that, we spew about $1 trillion a year into the rest of the world through a trade deficit. That's how the world gets the dollars that they need if they're going to keep using the dollar as the global reserve currency. And so those are kind of one and the same. Reserve currency status means supplying the world with dollars, which can be unpleasant in exchange for those benefits. And the problem is that the benefits are concentrated. So if you're the American government, you're the hegemony power. You're benefiting from it. If you're Wall Street, the whole world is taking those dollars and they're mostly reinvesting into our stock market, into our real estate to some extent, into our private companies, but especially our public markets because that's what we're kind of known for. And so you're kind of deindustrializing what is now called the Rust Belt. That's where it got its name from. So you're deindustrializing the Ohios, the Michigans, the Pennsylvanias. It's going to the rest of the world physically, all the industrial base, especially China. And then the rest of the world is reinvesting into U.S. financial assets, which is mostly New York, Silicon Valley, and a couple other urban centers. And so if you're in the dollar export business, as my friend Luke Groman, I think would call it, and maybe some others, you're doing pretty good. But if you're in the physical export business, or even just the making things domestically,
Yeah.
it's been a rough 4.5 decades.
Right.
So there's winners and losers. But the problem is those winners and losers, it's cumulative for decades. And so you get gradually rising populism along the way, because the people that are on the wrong side of that keep getting angrier and angrier. They're not necessarily articulating it the way I just did, because they don't necessarily work in finance.
Yeah.
But they know something's rigged against them. And it just, sometimes it ebbs and flows, but it keeps building and building and building. And so it kind of finally reached the point where trade deficits are now a top political topic. You have a president that, he was always prioritizing it. That was a thing. He was focusing on it even before it was a thing, really. But so he's the guy now that's like, it's the moment. So I think it makes sense that the U.S. is prioritizing its trade deficit now. Where I would be critical is the idea that we're a victim here. I mean, we encourage the system to be like this in the first place. We are reaping the benefits of having the global reserve currency. Or at least some of us are, the government and the people in New York and Silicon Valley and all that. They set this up, and now they don't like the downsides, or more like our predecessors set it up, and some of the people on the wrong side of it today don't like the downsides. And so the current administration is struggling, I think, because they're saying we want to fix the trade deficit, but we also want to be the world reserve currency. So then the question is, well, how do you supply the world with dollars then?
Right.
What are you going to do? So it's treating the symptoms rather than the root cause, because the root cause is very wonky to talk about. What I just said would go over terribly at a political rally, because it'd be like, what are you talking about?
Yeah.
It's way easy to be like, China's ripping us off. We're gonna stop that from happening. Don't you worry. So yeah, it doesn't go over well politically. And then two, it's scary when you hear there's downsides to the global reserve currency, and that maybe it's not good to have it in the same way. Like J.D. Vance has openly talked about that. At least he used to. Trump's chief economic advisor, Stephen Myron, talked about it. So it does pop up, but it's a delicate subject. And so I think that if I'm critical, it's to say that they're on the right path for what is important. There are some people in politics that say the trade deficit is not important. I disagree. After 40 years of like structural trade deficits, it's pretty important, and it's really mattering now. And we see that show up in kind of increasing populist politics. But the going after the surface level is going to give you a lot of pain and frustration, because it's still not tackling the root cause.
Yeah, and as you mentioned, you want the world reserve currency status, but you want your cake, you want to eat it too. $1 trillion cumulative trade deficit. I think I caught that correctly. Yeah.
Annual trade deficit, which is cumulative.
Yes. Perfect. That is the reason that we have so much diverse and high demand for the dollar. That's why that demand is so entrenched. That's the exact activity that's given us the flexibility to be lenient with our supply of dollars, right?
Yeah, I mean, the fact that it's more like it's self-reinforcing, because the whole world needs dollars, so they overvalue it, and that's how they get the dollars.
Yes,
So it's kind of chicken and the egg, but it's intertwined.
So I think you kind of maybe already hit on this, but when you hear the promises from the podium that we will fix this, we will reshore American manufacturing, and there's always like the line that might get you elected for another 2 years, and then the reality on the ground of how possible is this, right? At the beginning of this conversation, I think you mentioned the United States is now threatening to withhold weapons from Ukraine. And I'm sure the narrative is America first, we're taking a hard line, but in reality, it's like, oh, we just don't have the weapons anymore. We can't manufacture them fast enough. That's the reality. But from the podium, it's obviously a bit of gaslighting, something different. Let's rally the supporters. This is what we promised, to withdraw from wars. Do you think so much of these trade negotiations are similar? Like, how much of a reset between United States and China, United States and Europe, United States and UK, Canada, Mexico? Are we making meaningful progress, or is it more, I told you I was going to make America better, and see, I'm doing it, and don't worry about the details? What's your take?
I think it's still early to say because
Mm,
we're something like 6 months into this.
sure.
But in general, I take the under on how successful it's going to be or is being so far,
I see.
which is
Yeah.
to say that it's touching the surface. Now, it's not to say that tariffs can't be a tool in the arsenal for trying to change some of this. If the entire approach here would be, look, it took multiple decades to get here. Rebuilding a domestic industrial base is a long-term process, and we want to start that process. We want to be responsible for being the pivot point where maybe things don't fully come into place in 4 years, but that we at least can say we got the trend gradually starting to make sense again and going
Hmm.
back in the right direction. That's probably a realistic approach here rather than saying, by the end of the term, we're going to fix the deficit and we're going to have a vibrant manufacturing, boom in this many years. Um, an industrial base is worth trillions of dollars. It takes, so when you see an uptick in manufacturing spending, which partially happened, like the prior administration, they did, the whole like Inflation Reduction Act. However, the qualms might have with that name, there's a little bit of a manufacturing boost for like semiconductors and stuff. So there's already this little uptick in manufacturing spend, and people are pointing to that. It's not that it's irrelevant, but that's like you're measuring that in the billions versus the cumulative kind of value of a trade industrial base you need to build is in the trillions. So it's like you need many many years of that type of investment. So it's inherently a long range process, and then we're tariffing some of the components we need to build an industrial base. So it's not just like you're tariffing the cars. It's like you're tariffing the things you need to build cars to put it a certain way,
Right.
um, and so that also can make the expense higher. And it can it's when you're analyzing how sophisticated is the process so far. I would say because of things like that, not as sophisticated as it perhaps could be. Even if again the problem itself is real and worth addressing. So it's possible that we would say stop the trade deficit from going down this term, but it probably come at the cost of a weaker dollar, kind of maybe slower economic growth, those sorts of things, and those are pain points um, that people are probably going to have to pay.
Yeah. Okay. Yeah. I as a like a commodity investor, I try to look at things through that lens, and so a lot of this. So the steel workers have been rallying recently, and Trump was in Pennsylvania a month ago, and he's going to reshore the American steel industry and make Pittsburgh the steel capital of the world again. And from the podium, it makes sense. Let's bring back middle class jobs, manufacturing jobs, and steel manufacturing in America. And if you don't understand how steel is made, then that may all just sound super easy. Let's just do it, right? But the ingredients that make steel, the alloys, all come from, I'd say like Chinese or Chinese adjacent countries. Indonesia's got 61% of the nickel market. It's probably the most important alloy for any high performance steel, stainless steel. You need it. And their market share is going up. Um, and rare earth processing plus 90% with China. Rare earths aren't rare whatsoever. They're all over the earth's crust. It's the processing that's the hard part.
Yeah.
And how do you reshore political will that will support projects that take 10 to 15 years of testing and building to actually build multiple $1 billion, not hundreds of millions. And more importantly, pretty significant environmental concessions have to be made to build those plants. And in the sort of NIMBYism that we live in, it's just hard to see that reality ever actually manifesting. And so I think that's obvious that there's no substance here. This is all just rhetoric for the next 2-year election cycle. And that's most of it. That's most of what we're hearing. Do you think I'm being too sort of nihilist or pessimistic, or what do you think, Lyn?
No, I think you described it perfectly. And actually, before you mentioned NIMBYism, when you were saying that, I was gonna bring that up too, and you already brought it up. So I think you actually nailed the problem. That basically there's a bunch of things together. Anything that's physical is a lot harder than things that are like software or finance in a way. And so this is a very physical process. There's environmental impacts. There's not by NIMBYism, not my backyardism. Where there's a reason we haven't built like a new refinery in the U.S. in like decades because all these different
Mm-hmm.
regions just like no, we don't want it here. We want it somewhere else.
Mm-hmm.
Rare earths, like you said, they're not rare, but they're environmentally damaging and costly and complicated to get into their final forms. And so I think that's a very uphill battle. The other thing I would add is electricity generation and overall just energy usage. So steel needs a lot of energy to make. Data centers need a lot of electricity. China, they produce more than twice electricity that U.S. does. It's partially because of their high population, but it's also partially because they have this massive industrial base
Hmm.
that they make stuff with. So part of reshoring manufacturing, even if say we get around our higher labor costs, and going back to my prior point is another problem. U.S. has the highest per capita healthcare costs, which is a factor in labor costs. So if you're a manufacturing facility, your American workers are pretty expensive. Not just the wages, but their whole kind of healthcare package that they often get. So that even if you then skip that somehow and you automate the whole thing, there's still the energy component that has to
Hmm.
be rebuilt and accelerated. We've had stagnant kind of electricity generation for decades. So this is it's not I'm not entirely nihilistic on it. Not to say that it's impossible, just to say that it's an incredibly, like, unfathomably hard thing to do. That takes a long period of time with a lot of people doing it. And then lastly, there's also human capital. So we've trained like two generations of people to not go into blue collar, go into white collar.
Right.
Whereas China has built, like, there's certain hubs in the world where they get really skilled at something. So New York is skilled at investment securities. Um, Silicon Valley's got the whole network for startups and financing startups and connecting people to all the resources they need. There's certain areas. Boston's got healthcare pretty solidified, and these pockets exist. There are parts of China that had just massive manufacturing hubs. It's just, in addition to all the industrial base, it's a generation of people that know either how to be like experienced technicians or logistics, or they know all the supply chain stuff. They know how to manage these facilities. They know how to just optimize everything. That takes years to build that human capital. Um, and we've told a generation of workers, or two generations, not to do that, and that takes time to build up as well. So whether it's energy, human capital, environmental impacts, sheer time to build things, it's not just something you can just snap your fingers and transport an entire industrial base.
And to a degree, it just feels so unproductive to move backwards, and like the United States was the most advanced manufacturing hub in the world prior to World War II, right? And I might even argue that's why they were so effective. Today, we look at like advanced weapons technology and say, well, U.S. still has the most advanced weapons in the world, so they have the strongest military. And it's like, well, they didn't actually in 1939. They had the best manufacturing ability in the world. They were able to manufacture what was needed at a rate that was required. And that's why they were able to come out successfully. It wasn't because they had the most advanced. It was because they had the most, and today the most is obviously in China, but more importantly, they're also advancing that manufacturing industry at a rapid rate. I think 51% of the robotic manufacturing equipment last year was consumed by China alone. And so they're replacing manual labor with robots at the same time that America's promising to bring back manual labor. And it's just like, wait a minute, that shouldn't be the direction. And I don't know what the direction should be. Like, I don't, but just when I hear it, I'm like, this doesn't seem logical whatsoever, that the answer to our problems is 60 years ago and we need to go that way to become competitive in the future. I don't think that makes any sense at all, right?
Yeah, so I partially agree. I think the part that does make sense is that part of what fueled this degree of deindustrialization was that dollar system I mentioned before. It kind of forced that to keep happening. It's if you take that aside for a second, it's natural that especially the lowest margin things would go to cheaper markets. So plastic toys, textiles, that sort of thing. It's going to leave developed countries and go to developing ones. That absolutely makes sense. That's happened to other countries too. But higher skilled manufacturing, including automated manufacturing, um, a nation, especially one like the United States, generally wants to retain some of that. And as you have like 45 years of this problem in a row, it's become so lopsided. This hit policymakers back when during the pandemic. They were like, we can't even get ventilators. Why? We,
Mm-hmm.
can't, even for initially, they were like, we don't even have enough masks. China makes our masks. China makes our ventilators. They make just all these little things that we don't even think about. And then it's, well, now they have all the rare earths. They make 97% of the solar components. If people want to get into solar, and it's like, well, how, so especially because in the U.S. policymakers, they're kind of viewing China as a rising power and opposition. I don't necessarily think that's constructive to make that competition more fierce than it has to be. But they
Mhm.
view it like that, and they say, well, how can we have that competition if we're so reliant on them for so many different things? And like I said, you do get that political pushback. You get all these kind of deindustrialized areas, um, push back and say the trade deficit matters. I've been left behind. So there's political realities there. While I think it's not realistic that you're going to bring back a facility and have a bunch of people like working on textiles or working on these just high labor things. It does make sense to just not be so lopsided toward finance, software, and healthcare, and to have another generation that is more willing to get their hands dirty and become experienced in not necessarily coal mining per se, but in advanced manufacturing.
Yeah.
A kind of an ethic toward hardware, an ethic toward engineering, an ethic toward
Mhm.
skilled technicianship. I think that is an absolutely realistic and desirable thing, with the acknowledgement that that takes a generation to have that skill set and that those facilities kind of shift around.
Do you think that I think the rare earth angle is a massive lever? And as much as it is talked about, I still think it's somewhat underappreciated. And one thing you mentioned, there's a lot of pundits will make the claim there's a direct conflict slash competition going on between the US and China. And there absolutely is from, a few different angles, but this trending towards some sort of eruption of hot war, hot violence, like in the Southeast China Sea, I see it as incredibly unlikely just because the United States needs China's inputs for its own weapons. If I have a gun pointed at you, you're not going to sell me the bullets. Like it's a non-starter. I just don't see that reality because everybody knows it doesn't go anywhere. And I could be wrong, but do you think the U.S. maybe it's the dollar? What do you think the U.S. best answer is to the rare earth lever that I think is it's China's biggest lever right now because it puts a full stop on any high tech manufacturing and equipment, and they do control that. And despite trade agreements that we've seen over the last month, they still slow roll these export contracts for their exporters, and they know that they just have to wait 2 to 3 years and for the next administration, and they got to reset. So they can play the trade war game today, but they think long term because they don't have to worry about elections, et cetera. Does the U.S. have a comparable lever in response to that?
We have levers, but I'm not sure they're as significant as that one.
Mm.
We can certainly, we already are slowing down their manufacturing base to some extent, just because we're putting pressure on them. So it's not as though they come out of this unscathed.
Yeah.
But there's been this kind of rah like American power, whereas in reality, China has a ton of cards,
Mm-hmm.
and it's a pretty complex situation. There's something to be said for trying to develop some degree of rare earths elsewhere and then stockpiling, but again, that takes a while.
Yeah.
Um, this whole dollar dynamic, which ties in the trade dynamic, I think that the most sophisticated answer is something like Aikido, right? So if anyone's familiar with martial arts, Aikido is basically finding ways to use your enemy's momentum against themselves. It's kind of feigning weakness and being strong because of it, that sort of thing, or just acknowledging points of weaknesses and then working around it. And kind of the last analogy there is like, when Rome expanded, they overexpanded their borders, and then they found themselves just always struggling to maintain their expanded borders. And empires rarely pull back gracefully while they're already strong. They try to fight for everything they already have until it gets taken from them. And so I think that the answer is basically to say, okay, we're probably overextended here. We're doing everything. We're antagonizing our suppliers because we want to be the best at everything, and we want to extend our empire and keep it. When in reality, and we want to, for example, also have the global reserve currency while narrowing our trade deficit. And it's like, well, that's not necessarily how things work. I think part of it is ceding some of the reserve currency status. And basically saying, we support nations that want to diversify their reserves. We support nations that want to hold neutral reserve assets like gold or around the margins, even Bitcoin. This has become a Bitcoin-friendly administration. But basically, any country that wants to hold neutral reserves, any country that wants to make deals in other currencies. If, in fact, if China wants to make deals in Chinese currency with their biggest trading partners, we encourage it. Let that be your problem, so you're not always putting all the pressure on the dollar and basically forcing all this cross-border debt to be in dollars.
Mm.
That worked really well in our favor in the 80s, 90s, and 2000s, maybe. But the cumulative effect of that is now the downsides are hurting arguably more than the upsides we're getting from that arrangement. But that's generally not something you do. That's kind of like Rome kind of saying, from a position of power, look, our borders are kind of big. Let's give up a couple of these borders here and maintain the rest stronger. It's not usually how things go, but it's probably how I would hope they'd go.
Yeah. Okay. That's interesting. I want to hit you up with a couple sort of geopolitical questions that follow that to a degree. Do you have a take on so two directions I'll go here. The first, let's go with President Trump's visit to Saudi Arabia, UAE, and Qatar about a month and a half ago. And most of the headlines coming out of that talked about the airplane he was being gifted. But the material announcement I thought was the Saudi Arabian mining company Ma'aden signing a memorandum of understanding with MP Materials, which is a U.S.-based rare earth miner. It's one of two. And anyways, the agreement is to build full suite, full service rare earth mining, processing, refining, and distribution in the Kingdom of Saudi Arabia. And I thought, that's maybe an answer. If you could never get the political will at home to be competitive in a very important industry, maybe you can borrow that political will from a kingdom who doesn't have to worry about public opinion, elections, environmental considerations, policies can be pushed through, projects can be pushed through, very expensive ones can be funded. And maybe this is the ideal partnership for the US right now is that. Do you have a take on that, Lyn, or on the sort of Saudi-US relationship maturing here?
So I think there's a sophisticated realpolitik aspect to that, which is basically if you acknowledge it's hard to get rare earths domestically, the next best thing you can do is diversify your sources of them so that you're less reliant on one country. And then once you have diversified sources, you can build a really big stockpile as well. So that even if you have disruptions to some of those sources, you have longer runway of dealing with that. So I think that aspect makes sense. The U.S. has long been involved in the Middle East for a variety of resource things. Obviously, energy is the biggest component, and so anything else that they can get out of that is reasonable. It also, the downside is it entangles us militarily in that region for perhaps another generation. I think some of that is the U.S. also doesn't want Saudi Arabia to flip to Chinese currency in terms of being able to sell oil, being willing to sell oil in other currencies. Even I think that's probably an error. We probably should encourage them to sell. That'd be an Aikido move is say, look, fine, stop using the dollar for that. That's fair. It's just that's not how things are going to go. We're going to probably fight every tooth and nail to make sure as many countries as possible keep using the dollar. But I think the rare earth component makes sense in any sort of like agreement to diversify our strategic needs.
Okay. And then I guess staying in that region and staying with energy, as you just mentioned, when the United States struck Iran and supported Israel along the way, I was trying to look at that through the lens of trade, through the lens of raw materials, and say, if I knew nothing about the history and the politics, what would I see here? And another significant lever in global trade is the Strait of Hormuz. 25% of the world's oil and 20% of the world's gas goes through this little valve right along Iran's southern coast. And they've got absolute leverage over that. And could they actually shut it militarily? Probably not, but they don't have to. They just have to threaten it. And insurance companies will spike their premiums on the shipping companies. And the shipping companies have to decide if they want to pay a 500% increase in insurance and take the risk of something maybe happening or just not ship oil. And they're going to choose to not ship oil. They'll shut themselves down. Now, that's leverage that I'm sure the United States would love to have for themselves, right? And so when I started hearing these like hints at regime change from the American administration, I thought, wow, I wonder if that's it. Because between domestic American production and all of the Gulf states production, you could actually monopolize the oil industry if the United States has control over the Strait. In addition to Iran having the third largest oil reserves and probably the third largest natural gas reserves. Hard to tell because they're fairly undeveloped, but they're top three for sure. And as they're sanctioned, they can't send that oil to the global market. And so they sell it to China at a discount, sometimes up to like $11 per barrel, less than market rate. And they supply 51% of China's oil. And so there's like a handful of angles inside that dynamic that I was watching and wondering, is this Is this the sort of near-term end game that we may see here, the result that the U.S. is fighting for? Do you have a take on that, Lyn?
Well, it's a little bit outside of my area of expertise to try to envision what they're thinking. Probably one tendency in the administration, this is true for any administration, is you have multiple different groups. It's a classic thing of different advisors speaking to the king and trying to encourage them in their direction. So
Right.
there are certain groups that would have a certain view and certain groups have another view. We've already seen this on trade, for example, or on the dollar. One of the challenges is that the administration wants low oil prices because they want inflation down, and yet U.S. shale kind of needs higher prices. The production there is kind of gradually flatlining and rolling over, and we have very fast depletion rates. And the marginal decision to keep drilling there generally needs not only high oil prices, but an expectation of reasonably high oil prices for the next few years. And Treasury Secretary Percent wanted like 3 million more barrels. And it's like, well, that's not going to happen at current prices, most likely, unless you just artificially stimulate the heck out of it and kind of make up $20 a barrel difference, for example. So unless you do something pretty nationalistic like that, or kind of very strategic like that, these low oil prices are not conducive with that, which indirectly cedes market share elsewhere, at least around the margins. So if we do control the Strait and try to diminish oil and gas going through there, sure, we can take market share, but then we get higher energy prices most likely, and therefore risk higher inflation. So it's a challenge overall. I don't think it's really in the U.S. interest for the Strait to close for long periods of time. In theory, you can pressure China a little bit, but a lot of these things are pretty. There's workarounds for it, like as we saw when Europe faced energy crises out of Russia. They're able to like for example, Europe was able to outbid a lot of poorer countries in LNG. So it kind of diverted the energy crisis to like Pakistan, for example, and they'd have like electricity brownouts because Europe's outbidding them for gas. China has a lot of kind of firepower to do that as well. So yeah, I think that I just hope that it doesn't keep simmering. I'm hoping that the action's behind us. But geopolitics, where I touch on it when it relates to macro, but it's just not my area of expertise.
Yeah. Okay. I appreciate that. I'd love to know where you're seeing opportunity right now in the market, Lyn. Capital allocation. Where are you seeing undervalued asset classes? Where's the opportunity right now from your perspective?
So I'm bullish on emerging markets in aggregate, some spots more than others, but overall, my base case, and I could be wrong on this, but my base case is we're in a 5-year bear cycle for the dollar, and that this should be good for like the Brazils of the world, maybe the Southeast Asias. I think China's undervalued, so I'm pretty bullish on emerging markets. It's somewhat contrarian. I'm pretty bullish on U.S. financials. There's not a lot of people rushing to buy U.S. banks right now, but I like a lot of them, especially ones outside of the few big ones. So some of the ones in kind of the mid-sized ones I find interesting. Not that I think they're going to be explosive, but I think that they're undervalued and are going to do better than people think. Bullish on Bitcoin, structurally, but also cyclically still. Yeah, I think those are kind of my 3 areas of interest. I continue to be long gold. In the past couple of months, when it got heated, I kind of warned that I'm structurally bullish, but maybe it's due for a cyclical cool off. So far, we're a couple months into that type of cool off, which I think is healthy. So near term, a little bit uncertain on gold, but once we start to see it break out again, I would certainly not be in its way. I still think there's a structural trend toward countries wanting to own gold and repatriate gold more so than treasuries. So those are the areas that I find interesting. And then, around the margins, there are certain investments, individual equity decisions. I got after we had the big sell-off in semiconductors, I got back into that a little bit. So there are pockets of interest.
Yeah, when you say 5-year bear cycle for the dollar, immediately I thought if you're shorting U.S. dollars, your Bitcoin and gold. When you say structurally, could you define that a little bit for me and just expand on the concept of structurally long?
So structurally long means that I think that it's either going through an adoption process or something is changing for more than just a year, right? So for example, when I say I'm structurally long Bitcoin, I mean that we're 16 years into its existence. I think it's bootstrapping from zero up to some multi-trillion-dollar asset that I think is still going to be bigger than it is now. I still think it's ongoing adoption, and so I
Mm.
think looking back 5, 10 years from now, it's going to be bigger. And same thing
Okay.
for I think structurally or kind of secularly is another phrase. I think emerging markets are going through a pretty big cycle, maybe similar to the closest comparison would be the 2003 to 2007 cycle. I don't think it'll be that explosive. Base case, I mean, anything can happen, but I think a more muted version of that, we have weaker dollar, kind of a BRICS boom in a way, or an emerging market boom, at least better than they have been over the past 5, 10 years. Um, and the gold structural trend, from the 70s up until 2009, gold tonnage among central banks was on the decline. Ever since around 2009, it's been on the uptrend again. Ever since 2022, there's been an uptick in interest, kind of reaccelerating, for entities to say maybe we shouldn't have like 80% of our reserves in treasuries that can be just shut off like a light switch.
Mm.
Um, and so it's like, hey, maybe we can diversify our reserves. Maybe we can increase our gold allocation from 10% to 20% to 30%. Um, and so I think that is still an ongoing trend that is likely to persist.
Okay, I appreciate that. And last thread, can you just expand or dive in a bit deeper your bullish emerging markets, and then you mentioned some regions more than others. What countries or regions stand out to you as the most bullish, Lyn?
So I've been liking Latin America,
Mm.
Brazil, Mexico, a couple others, that area. Um, Southeast Asia in general, I think is pretty interesting.
Okay.
China is a tough case because I'd be more bullish if I was not American, because I think there's a non-zero chance that in, say, a 5-year time horizon, uh, Americans get zeroed out of their positions. I think
Mm.
I'd wait a low chance of that, but when you're waiting a low chance of getting zeroed out, it's still significant. So if you say there's a 5% chance to get zeroed out in 5 years, that impacts your valuations.
Yeah.
But I think Chinese equities are overly sold, and so yeah, whether it's South America, Southeast Asia, parts of East Asia, Eastern Europe to some extent, pretty bullish on emerging markets.
There's a non-zero chance you get zeroed out of your position. Do you think that's a two-way street? Is there a non-zero chance that the Chinese treasuries, U.S. treasuries owned by China, are zeroed out, frozen? I mean, I guess a non-zero chance, an easy one to answer. What's your take on that, Lyn?
There is. I mean, that's what happened with Russia, which is that, I mean, we zeroed them out, and then American, if they had Russian assets, they got pretty much zeroed out.
Mm-hmm.
And China, I think it's less of a chance of that happening. That's not my base case.
Yeah.
It's just more like if you weigh a 3%, 5%, 10% chance in a given time period, let's call it 5 years, you do the expected value, theorem for that. You say, well, 90% chance, let's say 80% chance it does well, 15% chance it's kind of just fundamentally doesn't do great, and then 5% chance you just get zeroed out regardless of whether it's doing well or bad.
Right.
You have to take that into account. Whereas I think non-American investors have a less of a reason to consider that. Um,
Mm.
and I think they would be reciprocal. I mean, if that were to happen, which again, not the base case, that probably would happen coinciding with us doing something with their treasuries, which I think is partially the case of why they're gradually reducing their treasury holdings. They're not like waking up
Yeah.
on a Wednesday and decided to just market sell all their treasuries, but over a 10-year period, they stopped accumulating, and then just over time, they just very gradually kind of diminishing their treasury holdings, reinvesting elsewhere. And I think that's probably going to continue because they have to consider the odds, that even if they don't invade something or do something extreme, there's still a
Mm-hmm.
chance. Now that would ricochet back in the U.S. because it's we've previously frozen the reserve of places like Afghanistan and Iran, and people are like, well, that's a unique case.
Sure.
Then Russia invades Ukraine, and that's the biggest case of us doing that, us in Europe. And people say, well, that's still involved in invasion. But if we do it to like a China, when just because we're like angry about trade or something,
Hmm.
that would really hurt the perceived credit worthiness of multiple countries. So I don't think we're going to be quick to do something like that, but you have to always consider the possibility.
And when you say Southeast Asia, any individual countries stand out to you, Lyn, as more promising than others or less promising?
So the developed market there would be Singapore, but also Malaysia, Indonesia, to some extent Thailand. I just find that area just kind of reasonable, not like amazing expectations, but I think it's underallocated. I think it's geopolitically safer than some of these other places, and I think it's going to continue to grind reasonably well over time.
Okay, appreciate that. Look, Lyn, thank you so much for your time today. It's great having you back on the show. I appreciate it.
Happy to be. It's been a while. Thanks for having me.
Yeah, all right.
Most investors think they're playing it safe, following mainstream advice, chasing trends, and clinging to the herd mentality. But there is nothing safe about mainstream advice. The smartest investors know that real wins come from thinking independently and spotting opportunities long before the crowd. And that's what we teach at the Commodity University. This is an exclusive membership designed to arm you with the skills from the sharpest minds in the mining investment world. Each of our professionals has a proven track record of finding trends before anyone else. At the Commodity University, you'll gain access to a highly curated and growing catalog of courses covering what you actually need to know to become an informed commodity investor. Every single month, you'll receive a brand new course packed with insights from the best in the business, giving you the edge to stay ahead. If you're tired of following the crowd and ready to invest smarter, think sharper, and understand the mining industry like the professionals, then take the next step and join the Commodity University today.